Welcome to Market Risk Management Frameworks and Strategies. I'm Jack Farmer and I'll be your instructor for this course. We're going to explore the different types of market risk and how you can manage those risks using derivatives and other strategies. To manage market risk in a trading book or portfolio, you need to have a full understanding of the factors that drive market risk for different types of investments. First, a bit about my experience in this area. I began my investments career working with a quantitative trading team that was part of a proprietary trading group at Bank of America. My responsibilities were both maintaining a risk management system and also designing trading strategies for the group's portfolio of derivatives on foreign exchange and short-term interest rates. Although I had risk management responsibility, all of my compensation was based on making a profit on the derivatives we held in our trading book. Now, you could argue that avoiding a loss through risk management is just as good as making a profit by trading, but the reality was that if I made a big profit, I could keep a good part of it. If, on the other hand, I lost all of the group's trading capital, I'd probably lose my job and have to look for another one, but I wouldn't have to pay the bank back for the loss. Key takeaway here is risk management is not just about risk factors and models. It's also about aligning incentives so traders and portfolio managers don't maximize their own profits at the expense of the firm. In this course, the focus is on managing risk rather than trying to make a profit, but the two are simply different sides of the same coin. The factors that drive risks and losses are the same ones that drive profits, because profit is just the realization of upside risk. Welcome to Module 1 of Market Risk Management Frameworks and Strategies. In this module, we're going to be looking at different financial instruments. First, bonds, and then stocks, and then looking at derivatives. We're looking at financial instruments because this is where market risk actually comes from. Market risk comes from the changes in the prices of financial instruments. And so when we talk about market risk factors, what we're really talking about are the prices of bonds, the prices of stocks, or even potentially the prices of derivatives on bonds and derivatives on stocks. So we're going to talk about market risk factors that we can use to measure financial risk in bonds or other fixed income securities, or in stocks or other types of equity securities. Then we're going to look at derivatives, which can be used to manage the risk in a portfolio of bonds or in a portfolio of equity securities. So we'll look at some examples of how you can use a treasury bond futures or possibly stock index futures to hedge or manage the risk of a portfolio of bonds or a portfolio of equities or stocks. Even though most retail investors focus on the stock market, the bond market is about 3 times as big in terms of value and is the primary focus of investment by institutions such as pension funds and insurance companies. Risk managers spend a lot of time identifying factors that impact asset prices and estimating the price sensitivity of different assets to those factors. Bond prices are mainly sensitive to 2 factors, interest rates and credit quality. We'll look at sensitivity to interest rates, which will build on what you learned about bond price sensitivity to credit quality, or the risk of default, in Course 2, Managing Credit Risk. To value a bond, you need to understand the relationship between interest rates, discounting, and present values. You also need to assess the size of the expected cash flows, the timing of those cash flows, and the discount rate or required return that investors expect to earn. Risk managers focus on changes in bond prices when interest rates increase or decrease. For government bonds, which don't have default risk, interest rates are the main risk factor. Also keep in mind that even though we are talking about bonds here, there's an entire world of fixed income products such as loans and mortgages that are also sensitive to interest rate risk. Bonds are contracts that promise a series of fixed interest payments up to maturity, along with the return of the amount borrowed, the principal, at maturity. We're going to focus on how this series of payments is valued in the market. To calculate the present value of a bond's cash flows, you need to know the interest rate expected by bond market investors. Each cash flow is discounted by 1 plus the rate of return raised to the amount of time to that cash flow. As you can see from the present value formula, you sum each of the discounted cash flows, including the final coupon payment plus principal, to calculate the present value or price of a bond. You can see in this example that the bond's price of $1,035 is more than the $1,000 par value or face value of the bond. Par value is the promised payment of principal at maturity. This bond is priced above par value because it pays a 6% annual coupon in a market where investors are willing to accept a 5% annual return. When you calculate the present value of a bond's cash flows using a 5% discount rate, you'll know what investors are willing to pay for the bond's expected cash flows. Calculating the present value is called discounting. In the table at the right, you can see that most of the value of the bond, $872, is contained in that final payment of principal and interest. This is generally true, especially for shorter-term bonds with lower coupon rates. To measure risk in a bond portfolio, you need to understand the relationship between prices and yields. Bond prices and yields have an inverse relationship. If yields rise, then prices fall, and conversely, if yields fall, prices rise. This could be seen in the previous example where a bond was issued at a price of $1,000 paying a 6% coupon. When market interest rates fell 1% and investors were willing to accept a 5% yield to maturity, the price of the bond increased to $1,035 or about 3.5%. A bond is trading at par when its present value equals its face value. A premium bond trades at a price greater than par when the coupon paid is greater than the yield required by investors. A bond sells at a discount when the coupon paid is less than the yield to maturity. You can see in the graph that the price of a bond does not have a linear relationship with the required yield. The price function for a bond is convex, so decreases in yield lead to growing increases in the prices as yields go lower. Conversely, increases in yields lead to smaller decreases in prices as yields go higher. This relationship is positive convexity. In this graph, you can see the price-yield relationship for a bond where prices and yields are both falling and rising. The bond price curve shows positive convexity as the curve is facing upward. As yields rise, the value of the bond goes down, but at a decreasing rate. As yields fall, on the other hand, the price of the bond goes up at an increasing rate. Here we see the same graph, but now we're trying to see how duration is related to the slope of the log of the bond's price curve. You can see that the duration is defined by the line that is tangent to the bond price curve at a particular yield and is defined by the slope of that tangent line. Duration is a linear first-order approximation of the percentage change in the bond's price for a given increase or decrease in yields. A plus or minus delta y is shown. You can see that for small changes in interest rates, when interest rates move up or down from y star by delta y, duration gives a fairly good approximation of the change in the bond's price. The duration line is very close to the bond price curve. But for larger changes in yields, such as plus or minus 2 times delta y, duration is a less accurate predictor. You can see a large gap between the duration tangent line and the bond price curve. Keep in mind here that the bond price curve represents the true price of a bond for a given yield. The duration line is just a linear approximation of that price curve. When yields fall, the price increase predicted by duration is much smaller than the actual price increase. When yields increase, the price predicted by duration is much greater than the actual decrease in the bond's price. Now, you could argue that this is good for risk management because you are overestimating your losses and underestimating your gains. But this would be false logic, as it is poor risk measurement and would lead to incorrectly deciding not to take risk. Risk management is not about minimizing risk. It's about identifying the combination of risks that are within your risk tolerance or budget that will maximize your expected return. To do this, you need to use the best risk estimators that you have available. Duration measures the interest rate risk of a bond by measuring the sensitivity of a bond to changes in interest rates. High duration equates to high interest rate risk, low duration to low interest rate risk. So interest rate risk is higher for long-term bonds, lower for short-term bonds. Macaulay duration is also equal to the cash flow weighted average time to maturity of the bond. Duration is an estimate of the percentage change in a bond's price per percentage change in yield. The Macaulay duration, which is measured in years, gives a rough estimate of the percentage change in a bond's price when yields change by 1%. For example, when yields increase by 1%, a bond with a Macaulay duration of 6 years would decrease in value by a little bit less than 6%. To get a more accurate estimate of the percentage change in the bond's price, we need to calculate the modified duration. Modified duration is equal to the Macaulay duration divided by 1 plus the yield to maturity. Modified duration is a more accurate estimate of how much a bond's price will change for each percentage change in the yield. It can also be used as a risk sensitivity measure for bond investors as it approximates how much a bond's price could decline with an increase in interest rates. Although modified duration is a better approximation of interest rate risk in a bond, it's still an approximation and is only accurate for small changes in interest rates. Excel has a built-in function to calculate modified duration. The information required is the settlement date, the date you buy the bond, the maturity date, the coupon and the yield to maturity, and how frequently are the coupons being paid. So for most government and corporate bonds, that's twice a year or biannual. There's also a feature for basis. So if a bond has an unusual day count convention, you can also add in that information. Now let's expand on the earlier example of a 4-period bond paying a 6% coupon per period. In the first part of the example, we assume that the yield to maturity was also 6%, so the bond's price was $1,000 or par. Now look at what happens when interest rates change. First, we assume interest rates increase by 2% to 8%, and then we assume they decrease by 2% down to 4%. When yields go up to 8%, you'll be discounting the cash flows of the bond using a higher interest rate, so the cash flows will have a lower present value. Now, when you total up the cash flows of the bond, they're only worth about $933, so we have a decrease of about $66 in the price of the bond. In the third column, interest rates have gone down by 2%, so you'll discount the cash flows by 4%, so the cash flow's present value is greater, and the price for this bond increases by $72.60. You can also see that the duration of the bond changes as the yield to maturity changes. When the yield to maturity goes up, the duration of the bond goes down, and when the yield to maturity goes down, the duration of the bond goes up. This is the effect of the convexity that we discussed earlier. In our next example, we're going to look at 3 10-year bonds that all have identical settlement dates, maturity dates, and yields to maturity, but have different coupon rates. The first bond is a 0 coupon, and so it's going to trade at a discount to par value. It has a par value of 100 and trades at 55.38. The time to maturity on the bond is 10 years, and the Macaulay duration is also 10 years. Recall that Macaulay duration is the weighted average time to maturity of the bond's payments. If all the payments occur at maturity is with a 0, then the Macaulay duration will be equal to the time to maturity. The second bond pays a coupon of 6%, so this bond will trade at par or $100, and it also has a time to maturity of 10 years, but its duration is only 7.66 years. You might ask, why does it have such a short duration? What's happening is that the value of the bond is not just the payment of principal at maturity as with a 0 coupon bond, but you're getting coupons each year, so you're getting a lot of the value of the bond in year 1 and 2 and 3 and so on when the coupons are paid. So this means that the duration of the bond will be lower, recalling that duration is the weighted average time for receiving the bond's cash flows. You can see this in the third bond, which pays a 12% coupon, so you're getting a lot of the value of this bond from the coupons and a relatively small amount of the value from the principal payment at maturity. This bond has a duration of 6.76 years, so overall, the higher the coupon on the bond, the shorter the duration, and the less sensitive the bond's price is to changes in interest rates. We've already looked at fixed coupon bonds that pay a fixed percentage of the face value or principal each period and then make a one-time payment at maturity. These are called bullet bonds. Then there are zero coupon bonds which make no coupon payments, so basically you're getting all of your value with a single payment of face value at maturity. These bonds are always sold at a discount to face value because you're receiving that face value at some future date. Annuities make a fixed payment over time which includes both interest and also the gradual repayment of principal. A good example of an annuity is a mortgage. When you pay a mortgage, your mortgage payment not only pays the interest on the mortgage loan, it also pays some of the principal each month. Perpetual bonds are more unusual, and you see them issued in some European countries. These have no redemption date, so they're called perpetuities. And all you're getting from that bond is the payment of interest, but forever. These bonds have very high, but not infinite durations. Floating coupon bonds pay a rate of interest that varies depending on the market rate of interest or the reference rate. These are issued by banks to finance the floating rate loans they make to their corporate borrowers. Historically, this reference rate has been LIBOR, although regulators are in the process of eliminating LIBOR as a reference rate and using other references such as the Secured Overnight Financing Rate, or SOFR in the U.S. Structured notes can have very complex payment patterns based on whatever return factor the investor has chosen. They can be notes that pay a return based on the price of a commodity or the price of an equity or a combination of an interest rate plus an extra return based on the price of a commodity or an equity index or even a particular stock. These bonds are mainly issued by investment banks and sold to hedge funds or high net worth investors who are looking for a particular risk exposure. The last thing we'll look at are inflation-protected notes. These are called TIPS or Treasury Inflation-Protected Securities in the U.S., but almost every major economy has some form of inflation-protected note. For TIPS, the protection is in the form of making the principal amount indexed to the consumer price index, so this means when you redeem the bond, you'll be given back more money than the initial face value of the bond. It also means that the interest paid on the bond, although it's a constant percentage, will be multiplied against an increasingly large principal amount so that your interest payments will go up over the life of the bond also. Yield spreads, which are often inaccurately referred to as credit spreads, are the difference between a risky bond's yield and the yield of a similar maturity risk-free bond issued by the government of the currency in which the bond is denominated. They represent the additional return that an investor gets for any feature of the risky bond that might lower the investor's expected return. Most of this extra return represents compensation for things like lower quality or risk of default. This is the credit spread. An investor facing greater risk of default would clearly want a higher yield or a higher return. Spreads can also come from differences in call features. Some bonds are callable, so the issuer or the borrower has the right to call it, which means they can pay back the lender and refinance the bond when interest rates are lower. This is to the advantage of the borrower, and they will have to pay a higher interest rate to have the option to refinance at a lower interest rate if interest rates go down. The amount of the coupon can also affect the yield spread because, as we saw with duration, the level of the coupon affects the duration of the bond. This means that a bond with a higher coupon will have a lower duration than a bond with a lower coupon, and so will have a lower yield if there is an upward sloping yield curve. This is because more of the value of the bond will be received earlier in high coupon cash flows, which would be discounted at lower rates. Other factors are difference in marketability or liquidity. If a bond is a larger issue, it tends to be more liquid or more marketable than a smaller issue bond. You see lots of small issue bonds in state and local bonds. The local bonds are usually made more marketable through the use of insurance in the U.S. Tax treatment is also a feature of state and local bonds in the U.S., where the coupons on these bonds are free from federal income tax. These bonds are usually held by individuals who would normally face a high tax rate on their coupon payments, and are willing to take a lower rate if the bond is federal income tax free. There are two main types of strategies in bond management. Passive management strategies are used by investors who believe that bonds or other securities are fairly priced and the return they receive is fair compensation for the bond's risk. Passive investors don't actively seek out trading opportunities. They tend to buy and hold bonds to maturity and maintain a stable level of duration in their portfolios. Active management strategies are similar to equity trading strategies where you buy undervalued bonds and or sell overvalued bonds. Another strategy is to invest in bonds based on your view of potential changes in interest rates or yield spreads or potential changes in the shape of the yield curve. One other strategy an active manager might use is to add leverage to their portfolio. They can do this by borrowing money short-term through repos to buy longer-term bonds. This is the typical strategy of a leveraged bond fund. They can also do this by using derivatives that give the manager a synthetic exposure to interest rates without having to put a lot of money up front as they would if they bought a bond in the cash market. The most common derivatives used for obtaining synthetic exposure are treasury bond futures and interest rate swaps. These derivatives can also be used to adjust the duration of a bond portfolio, which is the most common way for an active portfolio manager to increase or decrease their exposure to interest rates, and is also a widely used strategy to manage portfolio risk. We'll talk a bit more about this when we cover derivatives. Now we're going to look at the second largest category of investments by market cap and the category that most of you are probably more familiar with, equities. Equities represent the ownership of the cash flows remaining after bondholders and other lenders and creditors have been paid. These cash flows are much riskier than bond cash flows and are much harder to predict, which makes valuing equities a challenge. When we look at any type of investment and try to figure out what are the risks of that investment, what we're looking for are risk factors. These risk factors include what we've been talking about mostly so far, are just changes in prices that are paid within the market. We looked at interest rate risk, which for bonds at least is the effect of changes in interest rates on the price of a bond with a certain duration. But interest rate changes also affect other securities such as equities, because equities also pay a stream of uncertain payments which the market is discounting and trying to value. Business risk is present in both bonds and equities, and for equities it's primarily whether the business that issues the stock is going to make a profit or a loss that is greater or less than expected, and because of changes in economic conditions. Financial risk is also called leverage. This is where a business can add debt to their balance sheet by borrowing more money as opposed to issuing equity. This increases the default risk of the firm, and the risk factor is called financial leverage, which can be measured by the debt-to-equity ratio or the debt-to-asset ratio of the firm. Systematic risk is part of the total variability in an equity price that is due to changes in the overall market. So this would be measured by beta. Unsystematic risk is the part of the risk that's not related to the overall market variability. It's attributable to the unique risk factors of the particular company that issued the stock. Unsystematic risk is the risk that you can easily manage through diversification. There are three main ways that you can measure equity risk. The two that we've already talked about are standard deviation or volatility, which measures overall risk, and beta, which measures market risk or systematic risk or undiversifiable risk. The last one is value at risk, which we haven't talked about before. We'll cover value at risk later in this course when we talk about probabilistic measures of risk. The capital market line is the tangent from the risk-free rate on the vertical axis to the efficient frontier, which meets the minimum variance criteria. The point of tangency being the market portfolio. In theory, all points along the capital market line have a better risk-return ratio than the efficient frontier, the exception being the market portfolio where they are equal. If you are measuring risk in an undiversified portfolio, say of a single stock, then volatility is a good measure of the potential losses you could face as an investor. This is an unusual situation as most investors diversify their portfolios by adding other unrelated stocks and also bonds and other assets such as crypto. If your portfolio is more diversified, say a portfolio with more than 7 stocks and possibly some bonds also, then a better measure of risk is the beta of the portfolio as shown in the graph on the right. The capital market theory suggests that you should invest in a diversified portfolio with a market portfolio being the maximum diversification that you can achieve. A market portfolio is often represented by large cap indexes such as the S&P 500 for a U.S. portfolio and the MSCI World Index for a globally diversified portfolio. Ideally, however, it should include all investable assets such as real estate and alternative investments. Capital market theory, or CAPM, can be seen from 2 perspectives. As a portfolio manager, it tells you that stocks with a higher beta should have a higher expected return. As a risk manager, it tells you that once you have reduced risk as much as possible through diversification, the beta of your portfolio will tell you how much risk exposure remains. A larger beta means higher undiversifiable risk. Beta will be proportional to the covariance of your portfolio with the overall market divided by the variance of the market. Keep in mind that a beta of 1 means a risk equal to the market's overall risk. So as the market's risk increases, a given level of beta scales up to represent more absolute risk of loss in a portfolio. The capital market theory also proposes that it's optimal for all investors to hold the market portfolio. If you're more risk averse, then you can adjust your portfolio risk down by investing part of your funds in the market and part in bonds, which is also called a balanced fund or a 60-40. Or if you like to gamble, you can scale your risk up by borrowing money to buy more of the market portfolio. For retail investors, these are called margin loans. For hedge funds, this is called adding leverage and is how leverage funds achieve their higher returns and bigger potential losses by borrowing a multiple of anywhere from 2 to 10 times their base capital. Base capital is the equity hedge fund owners have, as opposed to investable capital, which includes borrowed funds. The derivatives market is where I began my trading and risk management career. The important thing about derivatives is they can be an investment class themselves and have unique risk profiles. They're also used extensively by risk managers to reduce risk in portfolios of bonds or equities or commodities, or really any other kind of investment. Derivatives can either be over-the-counter or exchange-traded. All derivatives derive their value from the value of another asset like a stock or a bond or a reference interest rate or an index. Unlike stocks and bonds, which are issued and traded publicly and used to raise either equity or debt capital, derivatives are private contracts between 2 parties. The derivatives market is huge, over $1,000 trillion in notional value. The market isn't this big because there's lots of speculators out there wanting to gamble using the levers provided by derivatives. It's that big because derivatives have unique features that allow hedgers to eliminate or limit risk in a precise and cost-efficient manner. Counterparty risk can be a major consideration for derivatives as gains and losses in a derivative contract are not paid out immediately by counterparties. One way to manage this risk is by using central counterparties or clearinghouses. Central counterparties guarantee the payment of the gains and losses incurred by each side of a derivative contract. Clearinghouses act as a counterparty to every buyer and seller. They reduce counterparty credit risk in several ways. One is by allowing the netting of transactions between counterparties. They also put in place credit procedures and require collateral deposits to be maintained to guarantee that each counterparty will make payments of gains and losses. If the counterparties do not maintain sufficient collateral, which is called margin for retail customers, then the clearinghouse has the right to liquidate their derivative position to protect itself from making any losses. Clearinghouses also maintain a joint guarantee fund against any unusual losses that might be created by extreme market moves. Clearinghouses have grown in size and importance in the derivatives markets. While they reduce counterparty credit risk, they could also pose a systemic risk because of the concentration of counterparty credit risk in a few very large institutions. This risk is fairly small, though, and most market participants expect central banks to bail out the clearinghouses if they were ever unable to pay their counterparty losses. Forward contracts exchange a given asset against cash or another asset at a future point in time. Farmers have used forwards to lock in the price of agricultural commodities for future delivery. In this case, they hedge against possible changes in prices before they deliver their crop. Swaps are over-the-counter derivatives that exchange a series of cash flows according to the terms of a swap contract. The cash flows can be tied to either equity prices, interest rates, exchange rates, commodity prices, or really any index. Swaps have longer maturities than forwards or futures. The maturity of swaps tends to match the maturities of the investments that they are hedging. So swaps are used a lot for hedging bonds which have longer maturities. Swaps can also be modeled and valued as a series of forward contracts. A swap may last for a period of years, but the exchange made at the end of each year of that contract is like a forward contract. There are also swaps for credit risk, and these are called credit default swaps. Here's an example of an interest rate swap with a $100,000 notional amount. The $100,000 notional is not exchanged. It's the amount of money you multiply the interest rates that are being exchanged against so you can calculate a net cash payment. At time zero, when the swap is agreed, the counterparties observe that market LIBOR is 2%. So investor A knows that they'll have to pay 2% plus 25 basis point times $100,000 or $2,250. Also, investor B knows that they will have to pay a fixed rate of 2.5% times $100,000 or $2,500 each period over the life of the swap. So from the very beginning, party A and party know that there will be a net payment of $250 to party A at time one. They don't know the other payments in the swap yet because they don't know what LIBOR will be at times 1, 2, 3, and 4. At the beginning of each future period, you observe LIBOR and use that rate to determine the floating rate payment at the end of each period. What you can see is that over the 5 years of the swap, there are going to be 5 exchanges made of LIBOR plus 25 basis points in exchange for a fixed rate of 2.5%. What we also see is that swaps are a way to hedge against changes in interest rates. In this example, interest rates, meaning LIBOR, have gone up during the 5-year term of the swap, which means that counterparty B, who's paying a fixed rate of 2.5% in exchange for LIBOR plus 25 basis points, is going to make a profit on this swap. So effectively, the fixed rate payer, investor B, has hedged themselves against increases in interest rates. This is similar to how a fixed rate investor who receives a fixed coupon on their bonds could hedge themselves against an increase in interest rates or a decrease in bond prices by entering into a swap where they are the fixed rate payer. Managers can either hedge out all of their interest rate risk, in which case they would be immunizing their portfolio, or they can hedge out part of their interest rate risk, which would be where they would be using a pay-fixed swap to reduce the duration of their portfolio or scale down the duration of their portfolio. The fixed payment they make in the swap offsets the fixed coupon they receive from their bonds. So they end up receiving a synthetic floating rate LIBOR. This is a common strategy for actively managed bond funds to shorten the duration of their portfolios synthetically. This is much cheaper from a transactions cost and tax perspective than selling long-term bonds and using the proceeds to buy shorter-term bonds to shorten the duration of a portfolio. Futures contracts are the same as forward contracts, where you have a party that is long or short agreeing to buy or sell a particular commodity or other financial investment. Unlike forward contracts, futures have standardized contract specifications and settlement dates and trade on exchanges. This standardization usually means futures contracts are more liquid and cheaper to trade than forward contracts. Their disadvantage is they can't be customized to match the exact size and maturity of the risk that you want to hedge. Trading on an exchange means that the exchange acts as a central counterparty and manages the margin requirements and credit risk for all of the contract holders by requiring the daily payment of gains and losses, which is also called mark-to-market. Financial futures give investors more of an opportunity to fine-tune the risk and return characteristics of their portfolios. Participants in futures markets can either be classified as hedgers or speculators. Hedgers buy and sell futures contracts to offset risk in cash positions that they hold. Cash positions are actual positions in bonds or stocks held by portfolio managers. Speculators, on the other hand, are looking for an exposure to a risk. They're looking to obtain returns similar to owning a stock or an index, or owning a bond or a portfolio of bonds or an index, and they do this by buying stock index futures or bond futures. Now let's look at a short hedge. Assume that an investor has a bond portfolio and wants to protect the value of that portfolio against increases in interest rates. To protect that position, the investor would need to hedge by going short or selling bond futures for some date in the future. For example, let's say it's June and the investor plans to sell the bonds in about 3 months. So she would sell September contracts. If the interest rates rise, she would have a loss on her bond portfolio, but the future she sold would gain in value. Here's the profit and loss graph of the investor's position. The upward sloping curve is the long position she has in bonds. The horizontal axis is bond prices, and as bond prices go up, the value of her portfolio goes up. Now, offsetting this is her short position in bond futures, which has exactly the opposite slope of her position in bonds. So essentially, being long bond futures is the same as being long bonds, and being short bond futures is the same as being short bonds. Now let's look at a long hedge. Assume a bond portfolio manager expects to receive an inflow of funds from investors in about 30 days. The manager's view is that rates are more likely to decline than increase, so she wants to lock in the current long-term yield on the funds she will have available to invest in 30 days. One strategy would be for the investor to buy bond futures contracts maturing in 30 days. This will lock in the current long-term bond yield. In 30 days, when she receives her funds and her bond futures expire, she will exercise her bond futures and take delivery of the bonds using the funds she's received from her investors to pay for the bonds. You can see that this graph is exactly the opposite of the one that we saw in the short hedge. Here, instead of having a long position that we're trying to hedge, we have a potential long position that we're trying to hedge. I know this sounds counterintuitive, but a potential long position is the same as being short bonds because you need to buy them. So here we have a short underlying position, so we need a long position in the futures or forwards to offset it, which is what the fund manager did. She entered into a position where she bought bond futures that matured in 30 days and then exercised those futures and took delivery of the bonds. In the next example, we'll look at hedging an equity portfolio holding $20 million of stocks with a beta of 1.2 relative to a large cap stock index. The spot index level is 4,010 and the observed futures price is 4,000 for a stock futures contract expiring in 3 months. The fund manager is concerned that the market will decline due to potential increases in interest rates sometime over the next 90 days, but does not wish to pay commissions and market impact costs or slippage by selling the stocks and then repurchasing them after the predicted decline. Now, as a risk manager, you must decide what is the risk minimizing hedge position that she would need to take using index futures. We're going to assume that the futures contract has a multiplier of $50 per index point. So this means that the hedge fund manager would need to sell $20 million, which is the value of her portfolio, divided by the index times the multiplier, which gives you a hedge of 100 contracts. This would match the exposure of her portfolio if the portfolio had a beta of 1, but the portfolio has a beta of 1.2. So she would need to sell 1.2 times as many contracts, or 120 contracts. Suppose the manager is correct and the index declines by 4% during the next 3 months. If our estimate of the portfolio beta is accurate and the portfolio declines by 1.2 times 4% or 4.8%, this would cause a loss of $960,000. If the futures price falls by 4% or 160 points as well, the gain on a single short futures contract would be 160 points times $50 a point, or $8,000. For 120 contracts, the total gain would be $960,000. Now, if instead the index had appreciated in value, the short futures position loss would have offset the gains on the portfolio, provided the change in the portfolio value was still consistent with that beta of 1.2 relative to the index. So either way, the manager has succeeded in temporarily adjusting the beta of the portfolio to 0 relative to the index. Here's the general solution to the beta adjustment problem. Say you want to know the number of contracts you need to buy or sell to adjust the beta of your portfolio to a target level. In order to calculate this, you need to know the target beta for your portfolio. That could be 0, or it could be lower or even higher than the current beta of your portfolio. If you're an active portfolio manager, you might want to take on more risk by synthetically increasing the beta of your portfolio by buying equity index futures. You might also want to synthetically reduce risk by selling index futures. The same would be true if you're an active bond portfolio manager. Instead of having a target beta, you would have a target duration and adjust the duration of your portfolio up or down by buying or selling bond futures. In order to manage the risk of your portfolio, you need to know the beta of your current portfolio, the beta of the index futures contract that you're using to hedge, the value of the portfolio that's being hedged, the contract multiplier, and the current futures price. Using this, you can come up with the optimal number of contracts needed to adjust your beta to the target level. This formula can be used when you're looking to scale the risk of your portfolio up or down, depending on your market view. Options are derivatives that give the holder the right to buy or sell an asset at a specified exercise price up to a specified expiration or delivery date. The exercise price or strike price is usually denoted with an X. Calls are an option to buy and puts are an option to sell. Options confer the right to buy or sell, but not the obligation. European options can be exercised only at maturity. American options can be exercised any time up until maturity. These diagrams summarize the features of call and put options. Buy a call if you think the price will rise, sell a call if you don't. Buy a put if you think the price will decline, sell a put if you don't. These diagrams show profit and loss for options. You can see that the break-even is not where the strike price is because of the premium paid by the option buyer. We'll look at some more examples so this will be clearer. One other term that you should be aware of is option moneyness. Options could be either in, out of, or at the money. Call options go in the money as asset prices increase. Put options, on the other hand, go in the money as asset prices decrease. This should make sense as call options let you buy at a fixed price, so as prices rise, they become more valuable. Put options give you the right to sell at a fixed price, so as prices fall, they become more valuable. At the money options are when the current price is close to the strike price of the option. If you exercise an in the money option, it will have intrinsic value, which means it can be exercised for an immediate profit. You should never exercise an out of the money option. Option premium refers to the upfront payment the buyer of the option, or the long, pays the seller of the option, or the short. The graph shows how the option premium affects the break-even price for a call option. In this case, the larger the call premium, the higher the break-even price for the call. Now we're going to look at a couple of option combinations that can be used for generating income and for risk management. The first is a covered call. With a covered call, you own the stock, but then to generate income, you sell a call option, usually an out-of-the-money call option with a higher strike price on the same stock. The trade-off here is that you collect a premium for selling the option, but you also give up some of the potential upside that you could earn on the stock if the price goes higher than the strike price of the option that you sold. This is a strategy that you would execute if you expected very little movement in the stock's price, such as in a quiet or a low volatility market. You could also use this strategy if you have a target price at which you want to sell your stock. By setting the strike price of the call option equal to your target price, you'll automatically sell your shares at the target price, plus you'll have collected the option premium for an additional profit. Of course, this assumes that the shares reach a price that exceeds the strike price of the call that you shorted. You can see from the graph that the net position of a covered call is equivalent to being short a synthetic put at the same strike price. Below the strike price, a short put has the same profit and loss as being long a share of stock. Above the strike price, no further gains are possible as the stock price increases. The only other difference is the premium you collected by selling the call, which shifts your break-even point down by the same amount. Protective puts are a common risk management strategy used by portfolio managers. With a protective put, you're going to buy a put option with a strike price that's below the market to protect the value of your stock holding if the stock price goes below that strike price. Protected puts are also called portfolio insurance. You can also see from the graph shown that the net position of a protected put and a long position in the stock is equivalent to being long a synthetic call at the same strike price. Below the strike price of the long call, no further losses are made as the stock price declines. Above the strike price, the long call makes gains the same as owning the stock. The only other difference is the premium you paid to buy the protected put, which shifts the amount of your break-even point up by the same amount. Now that we've covered the main financial instruments and derivatives, let's talk about measuring and analyzing market risk. First, from the perspective of probabilistic measures, and then from the perspective of statistical measures. One of the most important problems in risk management is determining the probability of a loss. In an earlier course, you looked at credit losses. With credit losses, determining your risk was a function of the probability of default, the dollar exposure you had at default, and the recovery you could expect if a default occurred. Instead of modeling credit events, we're going to be modeling asset prices and returns. To model asset prices and returns, we're going to need to assume that those returns or prices are distributed in some sort of meaningful way. We're going to look at different types of probability distributions that can be used to model asset returns and then determine the probability of different levels of loss given those distributions. Probability attempts to measure the distribution of random variables. These variables are financial risk factors, and they can include changes in equity prices, bond prices, foreign exchange rates, commodity prices, interest rates, indexes, and pretty much anything else you can think of. These risk factors determine the profit and loss in an investment portfolio, and that profit and loss function is going to be our probability distribution function. We're going to begin by looking at density functions. Density functions can be interpreted as providing a relative likelihood that the value of a random variable will be within a certain range of the sample values. A random variable can be anything like equity prices or bond prices, foreign exchange rates, or commodity prices. These prices are risk factors that we will use to model and analyze market risk. Our first example records the outcomes of rolling a pair of dice where there are 11 possible outcomes. These outcomes are shown in a table along with their frequency, which is just how often a particular combination comes up. Most of you are familiar with the probability of rolling two ones, so you can see in the table the probability of rolling two ones, or rolling a 2, is 1/36, and so happens 1 in 36 times on average. The probability of rolling a 3, which can happen either by rolling a 1 and a 2 or a 2 and a 1, is twice as high, so that's 2/36, and so on as you go down the list. What you should notice is that if you go to either very low outcomes like 2 or 3, or very high outcomes like 11 or 12, The probability is much lower than for outcomes of 5 or 6 or 7 or 8. What we've done here is to create a frequency table which shows the probability of each potential outcome and also the cumulative probability of each outcome and the one below it. So the cumulative probability will sum to 1 as there are only 11 possible outcomes, and the probability of all of the outcomes must sum to 100% or 1. Here's another way of looking at the same information. A histogram with each possible outcome represented along the horizontal axis, and then the frequency of each outcome represented by the height of the column. As you can see, the most probable outcome is a roll of 7, and the least probable outcomes are 2 and 12. You probably also notice that this histogram looks a lot like a normal distribution. It's not quite a normal distribution, but it certainly has a similar shape. You might also ask why, since we're taking a risk management course, are we talking about rolling dice, which is just gambling? The idea is that we're going to be doing essentially the same thing here in this course. We're going to be looking at the markets, which are going to be giving us prices, interest rates, indexes, and any other kind of information. And the market is going to be giving us this information in a fairly random fashion. We're going to take that information and create histograms like the one shown, which will allow us to potentially say something useful about the data that we've collected. Does it have a certain type of distribution? Maybe what type of distribution? A normal distribution or a log normal or maybe a Poisson or some other kind. We're going to be constantly repeating this process in order to model market data and measure market risk. Discrete variables are variables that can be obtained by counting. Recall the example of adding up rolls of 2 dice you saw before. Continuous variables are variables that measure something like a price or a return. Discrete variables assume distinct values, while continuous variables assume any value within a specified range. Now let's look at this a little more formally. The histogram that we just looked at is also called a density function. Here the probability density function, or PDF, is shown in the lower right-hand graph, and this is what you might call the bell curve or normal distribution. In the upper right-hand corner is the cumulative distribution function, or CDF. This is what we saw before as the cumulative probability of rolling the value of a pair of dice or any lower number. Now this is where it gets a bit more mathematical. The area under the density function is the total probability of all possible outcomes. So that has to be 100% or equal to 1. Also, the cumulative distribution function is the cumulative amount of probability and also has to max out at 1. And that's what we see here in the graph in the upper right. The cumulative distribution function mathematically is called large f of x and is equal to the probability that small x, which is a random variable, is less than or equal to any given value of large x. The cumulative distribution function is equal to the area under the density function up to that point. Now, those of you who are a bit more mathematical are seeing another relationship between these graphs. The cumulative distribution function is the integral of the probability density function. Flipping that around, you can say that the density function is the derivative of the cumulative distribution function. This means that the density function in the lower right measures the slope of the PDF. So these two graphs are intimately related, and essentially you're seeing the same exact information presented in two different ways. And as risk managers, you're going to be using this information, sometimes from the cumulative distribution function, sometimes from the probability density function, in order to measure risk, to measure the probability of a loss occurring, or to measure the probability of a certain size of loss occurring. To summarize, the cumulative distribution of a random variable is the probability that it will take a value less than or equal to its current value, and the frequency function, also known as the probability density function, calculates how often values occur within a range of values. This is the same as when we created a histogram and counted how many times did our roll of the dice come up with a value of 7 or 8 or 9 and so on. But now rolling a die or rolling dice is a discrete probability distribution where you have distinct numerical outcomes. With financial assets, financial prices, and returns, you have literally thousands of outcomes, and for most purposes, we assume prices and returns form a continuous probability distribution, which is what is shown in these graphs. Continuing a bit more with our mathematical description of univariate distributions, we say that large X sub t is a random variable from the perspective of today, which really is just saying we don't know what stock prices or asset prices or returns are going to be in the future. So they are a random variable from the perspective of today. Eventually we'll know what they'll be, but right now we don't. The distribution and properties and the risk factors are determined by X of t, and we have a cumulative distribution function, large F sub X of X and t, which is just the probability that large X is less than or equal to small x. We also have a density function, little f sub x, which is the partial derivative of large F of x with respect to probability. What you can see in the two graphs are that we can actually map a certain price from the density function in the lower graph up to a probability in the cumulative distribution function in the upper graph. So in this case, we've taken a price of 100, so the stock price is 100, and we're saying that maps to the distribution function with a probability of 50%. What this means is that 50% of the time, this distribution, the price of this stock or whatever asset, will be below 100, and 50% of the time it will be above 100. To make these assumptions about 50% being below 50% being above a price of 100, we need to assume that the distribution is normal or Gaussian. This is a common assumption when looking at financial variables. There are certain limitations to a normal distribution though. It's symmetric around the mean and can range from negative infinity to positive infinity. Unfortunately, most asset prices cannot be negative, and usually they have a zero lower bound. This means we need to change our distributional assumptions slightly to model asset prices. Here's an example that illustrates this problem. Assume that a stock has a standard deviation or volatility of 50% and the current price is 100. If we map out the cumulative probability of the density function, we can see that about 10% of the distribution falls below a potential stock price of $36. This is the same as a value at risk of 90%. This means that 10% of the time your losses on the stock will be greater than $64. Now the good news is 90% of the time your losses will be less than $64. The problem with this analysis is that your stock can't be worth less than zero. This means we need to change our distributional assumptions so that our distribution will not fall below zero. When modeling asset prices, we usually use a log normal distribution which correctly models a zero probability of prices going below zero. If you are modeling asset returns, these can be negative, but they still have a lower bound of minus 100% where price goes to zero and you have a total loss. A log normal price distribution is skewed to the right and has a zero lower bound. We'll talk about skew a bit more later in the course. Now we'll repeat our earlier example, but using a log normal distribution to calculate a 90% value at risk. Once again, we're going to assume a standard deviation of 50% and a mean of 100. In this case, about 10% of the distribution falls below $53. This means 10% of the time your losses will be greater than $47. 90% of the time your losses will be less than $47, or you'll make a gain. Recall from our earlier example that our 90% value at risk for a normal distribution was $36 or a loss of $64 with a 10% probability. This is larger than a loss of $47 that we had with a log normal distribution. So what's going on here? Since a log normal distribution cuts off losses at zero, it means it's not allowing for even greater losses as we saw with the normal distribution. So it gives you a more realistic picture of what your losses would be. Now we'll look at statistical measures of risk. Statistical measures of risk summarize and describe data that you have collected. It's often helpful to visualize data by using things like a histogram or a scatter plot. A useful feature of visual summaries is they help you spot outliers. A scatter plot allows you to see a trend in data and helps you see any kind of outliers that fall away from that trend. Although the data may show a trend, you can't identify which of the two variables is driving that trend. Outliers are important because they remind us that no matter what kind of trend or relationship we see, the data will often surprise us. Histograms also help you spot outliers, and they give you an idea of what kind of distribution is driving changes in asset prices and returns. You'll use a histogram like this when you examine historical data for a diversified stock portfolio in the final project for this course. A histogram tells you whether you can assume the data follows a normal pattern or not. It also tells you how often and in what ways normality might be violated. This helps you choose the right type of distribution for your risk model and what types of adjustments you might need to make to reflect the actual behavior of the market. You can also see in this histogram that there was a much higher experience of extreme gains and losses than you would expect in a normal distribution. As a risk manager, you would have to try to identify what is driving those extreme gains and losses. You could tell yourself that you don't really have to worry about the extreme gains, but a lot of times the factors that are driving extreme gains are the same ones that are driving the extreme losses. We've already talked about other summary measures of data, one being the mean or expected value of the data, and the median, which is the midpoint of the distribution. We've also talked about the quantile or cutoff point, which we saw when we were looking at value at risk. So when we looked at a 90% value at risk, we were looking at a quantile of 10% or 1 minus 90%. So a 10% probability of having losses that were greater than the value at risk loss. We've already talked about variance and standard deviation, which measure dispersion around the mean, but don't give us an idea about whether the distribution is skewed in one direction or the other, or whether kurtosis is present or not. So we're going to talk a bit about what are called higher moments of distributions, which give us an idea about how the distribution is shaped beyond these measures of dispersion. If we have a symmetric distribution, then the mean, median, and mode all occur at the same point in the distribution. But if we have a distribution that is either skewed to the right or the left, the mean, median, and mode will occur at different points. The distribution shown is skewed to the left, and you can see that the mean is less than the median, which is less than the mode. If the distribution had been skewed to the right, then the mean would be greater than the median, which would be greater than the mode. When we talk about measuring distributions of asset prices and returns, positive skew means skewed to the right or skewed towards positive asset prices or returns. Negative skew means skewed to the left or skewed towards negative returns or lower asset prices. Kurtosis is the second most important statistical measure that you'll use as a risk manager. Risk management, by its nature, is concerned with extreme gains and losses. This means that risk management is focused on the tails of the distribution, where the big gains and losses happen. There are three broad categories of kurtosis. Normal kurtosis, or mesokurtic, is considered average tail, like the normal distribution shown here in blue. Leptokurtic, which is the riskier distribution shown in green here, is fat-tailed. This is where you have a higher probability of extreme losses and gains if the distribution is symmetric. Platykurtic, where kurtosis is less than 3 and the distribution is thin-tailed, which means you have a lower than normal probability of extreme gains and losses. When you look at the data for the stock portfolio project, you'll see that the distribution of returns is leptokurtic. Stock and stock index returns are consistently leptokurtic over longer time horizons. Two other important statistical measures are covariance and correlation. Covariance is a measure of the joint variability of two random variables, how much they move together. The correlation coefficient is a statistical measure that calculates the strength of the relationship between the movements of two variables. Its value ranges between -1, which is perfect negative correlation, and +1, which is perfect positive correlation. Correlation of 0 means that there is no measurable relationship. The correlation coefficient also measures the strength of the relationship between two variables. The closer the correlation coefficient is to -1 or +1, the stronger the positive or negative relationship between the two variables. When the correlation coefficient is close to 0, that indicates weak correlation and no statistically measurable relationship. One other thing to note is that financial data is usually presented as a time series. So when you have a series of prices or a series of returns for a particular asset over a period, This time series is highly correlated with earlier observations of itself. This is called serial autocorrelation. This means that the price of an asset 1 second from now is highly correlated with the price of the asset now. The amount of serial autocorrelation usually declines as the time lag between asset prices increases. In general, financial assets, prices, and other financial variables show high serial autocorrelation. Here are some scatter plots of data. In the first graph, the data is highly positively correlated, and the correlation coefficient here is almost positive 1. It's 0.99. So there's strong positive relationship between the variables. In the first graph, data form a line with a slope of positive 1. In the middle graph, we basically have random scattering of data, correlation is 0, and there's no observable relationship between the variables. In the graph on the right, correlation is negative 0.99, so we have a strong negative relationship between the variables, and the graph roughly forms a line with a slope of negative 1. The math for linear regressions is not complex. What you're trying to do is take a set of data and fit a line through the data such that the line minimizes its distance from each of the data points. These distances are called the residuals or the errors. You use regression analysis for two main reasons. You want to study the magnitude and the structure of the relationship between two variables. And you also want to forecast the value of one variable based on its relationship with another variable. So that means that you want to estimate the slope of this line in the case of a relationship between two variables. The structure of a single variable linear regression is that the expected value of y is equal to a, which is also the intercept, plus b times x. B is the estimate of the slope. The expected value of y is the dependent variable for a given value of x. X is the independent variable, which is what you're using to help predict or better understand the dependent variable. Little a, also known as alpha, is the y-intercept. It's the point at which the regression line intersects the y-axis, or where the independent variable is equal to 0. B, or beta, is the slope or the amount by which the dependent variable changes when the independent variable increases by 1. Now the math shown here shows that there's a true relationship between the variables, and what you're doing is with a regression is just trying to estimate that true relationship. As you can see from the numerous errors between the observed data and our regression line, our estimate is not perfect by any means, but it is still useful. Here's a regression done on Bloomberg of Apple versus the S&P 500 index. Now, as you should remember, when you regress a stock against the market index, what you get is the stock's beta. The data shown here are weekly returns for Apple and for the S&P 500 for a 2-year time period. So there are 103 weekly return observations used for this regression, which covers the end of January 2018 to the end of January 2020. Based on the regression, you can see that the beta for Apple is 1.02 or very close to 1. So Apple has almost the same beta as the market as a whole, or as the S&P 500 in this case. Now the question is, for you as a risk manager or as a portfolio manager, is could you just hold Apple instead of holding the S&P 500? Would the two be the same from a risk and return perspective? To answer this question, you have to first look at how strong is the relationship between the beta of Apple and the beta of the S&P 500. One way to measure this is by looking at the standard error of the beta, which is 0.086. This is relatively small compared to the beta of 1.02, so you can be highly confident in this estimate. The question is how confident. If you use a t-test, you can see that the t-test statistic, which is just the beta divided by the standard error of the beta, is equal to 11.8. This means you can be extremely confident that there is a strong statistical relationship between the beta of Apple and the beta of the S&P 500. The question is, would it be reasonable to invest in Apple instead of the S&P 500? Now, Apple is the largest cap stock in the S&P 500 index and also in the NASDAQ 100 index. So it might be tempting to say, oh, I can just invest in Apple, not have to bother, buying all the other 499 stocks in the S&P 500. The problem is there are going to be certain weeks when the performance of Apple is going to be a lot different than the S&P 500. Here I've zoomed in on the graph a bit, and you can see that during 1 week, Apple was up 15%, a really great week for Apple, but the S&P 500 was only up 1.7%. Now this could have been a week where you definitely would have wanted to own Apple rather than owning a basket of 500 large cap stocks. The problem is there are also weeks where Apple did a lot worse than the S&P 500. In the example I've circled, Apple lost 7.5% in 1 week, where the S&P 500 was only down by 2.5%. Now you can say the outperformance of the outlier in the upper part of the graph makes up for the underperformance in the lower part of the graph. It actually more than makes up for it. But as a risk manager, you should not be comfortable with saying investing in Apple is the same as investing in the S&P 500. To further illustrate this point, look at the data in the upper left quadrant of the graph. In this quadrant, Apple is showing a positive return and the S&P 500 is showing a negative return. During the 1 week, Apple gained over 2%, while the S&P 500 lost almost 5%. If you were a manager with an S&P 500 index portfolio, it would not be effective to manage your risk by shorting Apple shares. You should have a good understanding of the risks that are inherent in the different types of financial instruments and of the derivatives that you can use to hedge these risks. You should also be familiar with the different methods for measuring and analyzing each type of market risk. Now we'll look at how risk managers model and manage market risk. Market risk measurement systems are the nerve centers for risk management systems at banks, asset managers, hedge funds, and insurance companies and pension funds. Risk measurement was originally based on measures such as volatility and variance, which are return-based measures. The problem with return-based measures is they don't translate easily into an amount of money that can be allocated against available risk capital. Whether you work in a large bank or a small investment firm, risk capital will be tightly controlled and carefully allocated. As a risk manager, you will be a part of that allocation decision. Position-based risk measures such as value at risk are better suited for capital allocation because they tell you how much your portfolio might lose based on a time horizon and level of confidence that either you choose internally or your regulator chooses for you. Stress testing, by contrast, starts with an assumption of extremely adverse conditions and then calculates how big your losses could be if these conditions were to occur. The conditions assumed in stress testing are usually specified by risk management or by your regulator or both. Financial risk exposure comes from market, credit, and operational risk, and also from the interaction between these three risk categories. In previous financial crises, there have often been problems in credit markets that eventually affected equity markets. Recently, we've seen crises in operational failures such as ransomware and hacking and data theft that have had a negative impact on the stock of companies involved and sometimes on entire industries. Notional limits set a dollar limit on exposures to a particular asset. These are combined with sensitivity measures like duration to come up with risk measures of dollars lost per 1 basis point increase in interest rates. The problem with these measures is that they don't answer the larger question of how volatile are interest rates and what is the probability of an increase or decrease in rates of a certain amount. To answer these questions, you need to create an interest rate model, which you could then feed into your value at risk model. Sensitivity measures also don't allow positions to be aggregated across all markets. Value at risk provides information to counter all the weaknesses of notional and sensitivity measures, though notional and sensitivity measures continue to be useful to set limits and to control risk. Another useful tool is the stop loss. This can be used by risk managers or by portfolio managers to enforce position cuts after losses occur. This would be where you have a holding in your portfolio that is making losses, and you have to decide when you're going to start selling that position out of your portfolio and reduce those potential future losses. This is probably the most important aspect of having a successful trading strategy. Many traders are good at coming up with great ideas, but are not able to let go of those great ideas when they turn out to be losers. Risk measurement systems combine 3 steps. First, collect portfolio positions and map those positions to risk factors. This means having a data warehouse storing all of your positions and then also identifying the key risk factors that drive risk in each of those positions. Next, using historical market data, you need to construct a distribution of those risk factors. We've already done this in previous examples by creating a histogram from historical data and using the shape of that histogram to create a distribution and to make distributional assumptions of normality or log normality. Lastly, you need to construct a distribution of portfolio returns using one of 3 methods, either parametric, historical, or Monte Carlo, and then summarize the downside risk with a risk measure such as value at risk. The true level of risk can be greater or lower than the value at risk measure. Your risk is based entirely on your choice or the regulator's choice of a time horizon and a confidence level. If you choose a longer time horizon or a higher confidence level, then you're going to come up with a larger value at risk loss. If you choose a shorter time horizon or a lower confidence level, then you're going to come up with a smaller value at risk loss. You need to choose risk factors so that they represent all of the important risks that affect your portfolio. Statistically, you would say that the factors adequately span the risk of your portfolio. The idea here is not to explain all of the risk in your portfolio by choosing a lot of risk factors, many of which might be highly correlated with each other. The idea is to choose the minimum number of risk factors that are not highly correlated with each other to explain enough of the risk or capture enough of the risk that they can be used to create a useful risk model. Sometimes the number of risk factors is really quite large. So risk managers need to make reasonable approximations in order to reduce the number of risk factors so the risk can be calculated in a computationally efficient manner. Value at risk simulates the current portfolio's risk using recent history. You use market data to construct a frequency distribution or histogram of daily returns. These returns are ordered from the worst to best, as you can see in the graph on the right. The goal here is to first determine what kind of distribution you have. The worst return you can have is minus 100%, so the histogram of returns has a log normal distribution. And then to summarize that distribution with a single number that tells you the level of loss that will not be exceeded at a level of confidence that you have chosen. In the example shown, that level of confidence is 90%, and the value at risk loss is 50% of your portfolio's value. You can also generate a value at risk number using a Monte Carlo simulation. You assume a particular density distribution for the risk factors that affect your portfolio and then draw random samples from these distributions to generate return paths for your portfolio. You do this hundreds, maybe thousands of times, and this allows you to simulate a terminal price distribution that is shown on the right of the graph. Using this terminal price distribution, you can then determine a value at risk for a chosen level of confidence and time horizon. In the example shown, we have chosen a 90% confidence level and a 10-day time horizon and calculated a value at risk loss for our portfolio of 50%. Value at risk does not describe the worst possible loss. It bases its calculation on a confidence level, so the loss is dependent on that confidence level and the time horizon. Value at risk is measured with some error and is subject to normal sampling variation. Also, value at risk does not describe the greater losses in the left tail. These are the extreme losses that exceed the value at risk losses. In order to estimate these losses, we use another risk measure called conditional value at risk, or expected shortfall. Expected shortfall is called conditional value at risk because it's conditional on you having exceeded the value at risk loss limit. Expected shortfall is how much, on average, you'll lose once the value at risk loss is exceeded. It measures the average loss in the left tail. Mathematically, we could calculate this by taking the integral of the density function from 0 to the value at risk cutoff and dividing that by the area in the tail, which in this case is 5%. The area in the tail is the probability of having a loss equal to or greater than the value at risk loss. In the final project for this course, we'll work on an example where we calculate the value at risk and expected shortfall for a portfolio of several different equity indexes. So you'll get an opportunity to see how expected shortfall and value at risk are calculated using an Excel model. To sum up, value at risk requires two quantitative parameters, the confidence level and the time horizon. The choice of confidence level depends on how you plan to use the value at risk. Typically, value at risk is used to measure downside risk, and what matters most is the use of a consistent value at risk and confidence levels and time horizons across trading desks. If value at risk is used to decide how much capital to set aside to avoid bankruptcy, then a higher confidence level would be required. Value at risk models should also be back-tested to determine the frequency of losses that exceed the value at risk loss for a specified confidence level. For instance, in an annual backtest of a value at risk model with a 95% confidence level, you would expect around 5% of the time the losses in that portfolio would exceed the value at risk loss level. The longer the time horizon, the greater the value at risk measure. Time horizon is also called the liquidity horizon because when a value at risk loss or bigger is made, it is likely that part of the portfolio will have to be sold off to limit future losses and reduce risk. If the portfolio contains illiquid assets such as real estate or loans or complex derivatives, it may take several days to sell them off. This means that you may experience several more days of losses before you can liquidate your position. This is not a concern in normal markets, but when markets are stressed, they can often effectively shut down, leaving you stranded in your losing position. You can adjust your one-day time horizon and value at risk to a multiple-day value at risk by multiplying the square root of the longer time horizon. This adjustment is valid when you have an independent and identically distributed returns and have a normal distribution. The Basel Committee on Banking Supervision recommends rules for determining capital requirements for banks throughout the world. They suggest a market risk charge based on the bank's internal value at risk and require 1, a time horizon of 10 trading days or 2 calendar weeks, and 2, a 99% confidence level, and 3, an observation period based on at least a year of historical data that is updated at least once a quarter. The Basel Committee rules also allow a 10-day value at risk to be calculated from a 1-day value at risk as shown here. Value at risk for a 99% confidence level 10-day time horizon is equal to value at risk for a 99% confidence level and 1-day time horizon times the square root of 10. The last area we'll look at are stress testing and scenario analysis. Stress testing and scenario analysis became popular during the financial crisis because many risk managers felt that models by themselves were not sufficient to measure or model risk. They felt that models needed to be augmented by considering different historical or made-up scenarios or by considering situations of extreme stress in calculating value at risk losses. A stress test is just a projection of the financial conditions of a firm or an economy under a specific set of adverse conditions. It can include one or more risk factors. The scenarios can either be simple or complex and are extreme but still plausible. This means that you're looking at a really bad situation, but it's something that could happen as opposed to a situation so bad that no one could conceive of it ever happening. During the financial crisis of 2007 and 2008, risk management systems failed at many firms, and firms realized losses that were far greater and far more frequent than what had been anticipated. Value at risk is a good measure, but like all risk measures, it has limitations. The lessons learned in the 2007 recession and financial crisis is that relying on recent data may not be sufficient to assess risk, which is why value at risk models need to be supplemented by stress tests. Stress tests strive to identify events that could cause extreme but plausible losses. By adding assumptions, though, stress tests are much more subjective than value at risk measures. The purpose of a stress test is to inform the risk appetite framework. It also allows management to set appropriate risk policies and ensures that the risk exposure does not exceed the capital and liquidity available to the firm. This ensures that the firm can survive an extreme but plausible risk event. Stress tests are also very useful for identifying the magnitude of tail risk. You could say that stress tests explore the left tail of the distribution by looking at situations where extreme losses are likely to occur. Features of stress tests include taking normal models and then stressing them by increasing the volatilities and stressing the correlations, usually by increasing the correlation between different asset categories. Once you've run your stress test model, then you have to decide what you're going to do in response to the outcomes of that stress test. Other considerations are what kind of scenarios do you want to generate? Scenarios will be specific to the type of asset that you're holding in your portfolio. You also have to identify the risk drivers appropriate for the assets in your portfolio. Evaluate the availability and quality of the data that you have to create a stress test. Also, does your risk management department have the ability to model risk accurately? Once you've made your stress test calculations, you need to aggregate these across all of the portfolios in your firm and report the overall results and the overall risk exposure of your firm. Stress tests are best employed for high-severity scenarios that have relatively few risk factors. Scenario analysis usually has multiple risk factors that could be triggered as volatility catalysts. In either case, both should focus on extreme but plausible events. Stress testing is critical to guarding against event risk, which often arises due to emerging and strategic risk. It's the nature of these risks that they do not occur frequently and may be very difficult to anticipate, but when they do occur, the results are often catastrophic. These risks can come from things such as monetary or fiscal policy changes, environmental changes or extreme weather, marketplace disruptions from new technologies or participants, or geopolitical risks and system failures. Scenario analysis and stress tests are not easy to design or build, but recent years have shown that volatility is increasing and markets can be taken by surprise. The goal of both of these is to ensure that firms can withstand extreme but plausible scenarios without going bankrupt or experiencing financial distress. In creating scenarios, you should go through a systematic process of obtaining expert opinions from business line managers and risk management experts to derive a reasoned assessment of the likelihood and loss impact of plausible high-severity operational losses. Scenario analysis examines and evaluates possible future events, possible but unlikely. They need not be derived from historical events, and it's a common fallacy that you can always find the worst possible case in something that happened historically. You can certainly find something pretty bad as far as market events and system failures and so on in history, but that doesn't necessarily mean that it's going to be the worst thing that's ever going to happen to your firm or your portfolio. The purpose of creating scenarios is to prepare for unexpected events so you can identify key risk exposures, especially emerging and strategic risk, and explore potential extreme events. This allows you to mitigate the risk of illiquidity and insolvency. A scenario analysis puts a portfolio through a test that has large movements in financial market variables. These scenarios can be created using various methods, including moving key variables one at a time, because it's not likely that all of the market variables are going to move at once. You can also use historical scenarios such as the 1987 market crash, where the S&P 500 and the Dow Jones dropped by about 23 or 24% in one day. Or more recently, where U.S. equities sold off by 34% in 4 weeks at the beginning of the COVID epidemic, and then eventually recovered to record highs. You can also create possible scenarios by trying to imagine the worst thing that could possibly happen to an existing position. Also, regulators often require what are called reverse stress tests. They ask you to assume a large loss that would cause you to be insolvent or go into bankruptcy, and explore the situations that could potentially give rise to that loss. The idea here is that you should have in your mind a scenario that could potentially put you out of a job. Welcome to the Market Risk Management Project. In this course, we spent a lot of time talking about different types of market risk. Market risk for equities or stocks, market risk for bonds, and also looked at different types of derivatives that you can use to manage that market risk. We then looked at how you can use probabilistic measures and statistical measures to measure that risk and get an idea of exactly what type of losses that you might face as an investor or as a portfolio manager. Now, in this project, we're going to go through a process that you would go through as a risk manager. And that process starts with identifying a portfolio that you want to measure risk for, looking at the data set that you have for that portfolio, the historical data set, then analyzing that data set and coming up with some statistical measures of risk, also the kurtosity of the portfolio, and so on. And then finally, what we talked about before in the course, coming up with value at risk numbers. And what we learned in the course is that value at risk is the risk that won't be exceeded with a certain level of confidence. And so what we're going to look at in this project is different levels of confidence and how that affects the value at risk loss number. So let's get started first by looking at the data set that we're going to use. Okay, our data set covers 2 years of trading information, of trading prices. And it's a data set on 4 equity indexes. So we have a portfolio that is globally diversified, and it's composed of equity indexes from the US, Japan, China, and the EU. The indexes that we're going to look at are the S&P 500, the Nikkei 225, the Hang Seng Index, and then the DAX Index. Now, we're going to look at 2 years of data from those indexes and basically look at the value of a portfolio of those indexes for 2 years starting in February of 2018 and ending in February of 2020. Now, I've chosen this time period deliberately in order to look at a period before the COVID epidemic, or not exactly before the COVID epidemic, but before the market really had a good idea of how much volatility and risk and uncertainty was going to come from that epidemic. So we're going to look at a 2-year period because, as you can recall from the course, if you're going to analyze a historical data set, then you should have at least 2 years of data to do your analysis. And 2 years of data is roughly 500 trading days. So our data set consists of 500 days of trading in each of the 4 indices. Now, since some of these indices are not denominated in dollars, we're also going to need information about the exchange rate. The exchange rate in this case for the Hang Seng Index, which is based in Hong Kong. So we need the exchange rate for the Hong Kong dollar. For the Nikkei Index, which is based in Tokyo, we're going to need the dollar yen rate. And then for the DAX Index, which is based in Frankfurt, we're going to need the euro dollar rate. So we need that information because in order to measure risk, we have to measure it in a single currency. And in this case, we're choosing the dollar as our reference currency or our reporting currency. Now, you don't have to do this. You could also measure the risk in this portfolio in Hong Kong dollars or in yen or in euros, really in any of the currencies that the indexes are based on. Now, this is true of any kind of risk. I mean, you need to measure the risk from the perspective of your investors or your organization. What is their reporting currency? So anyway, let's look at the data. So the data that I have shown here are ordered from day 0 all the way down to day 500. And I'm not going to show you all the way down there, but you can see, quite a lot of data here. And what I have is our first date is February 26, 2018, and that's day 0. So actually I have 501 data points here, and that will allow me to get 500 daily returns because you need 2 days to get a return. Okay, so we're going to be looking at the daily returns for this portfolio of these 4 indexes over 500 days up to right before the market started realizing that COVID was going to be important. And we want to get an idea of whether the market had any sense of the risk that was coming, or if the market pretty much had no idea that the risk was coming. And you as a risk manager back in 2018, or excuse me, back in 2020, probably wouldn't have said that there was very much risk in this portfolio. Now, keeping in mind that the second part of this project, we're going to actually look at the same data, same portfolio, but we're going to shift our time frame forward by 6 months. So we're going to look at 6 months of new data starting in February of 2020. And we're going to drop out the first 6 months of data that you see here, going roughly from February of 2018 to August of 2018. But anyway, so let's just focus on what we're looking at now. So we have 500 days of trading data and 4 indexes, and we're going to combine this into a portfolio. Now, before we combine it into a portfolio and convert each of the non-dollar indexes into dollars, let's have a look at what's going on in each of those indexes over the 2-year period. And the best way to look at that is just to look at a graph of the index over that 2-year time period. So let's look at that. All right, so in the upper left-hand corner, you see the S&P 500, and this shows over that time period from February 18 to February of 2020. And you can see that pretty much, not a whole lot of volatility there. You see a little bit of a down move here, there. And overall, though, the market has gone from a level of roughly 2,700 here up to about, 3,300 here. Okay. Now, that's the S&P 500. That's going to be 40% of our portfolio. And now I've chosen the portfolio allocations to more or less mirror the market cap of stocks in that particular country. Okay, next, the Hang Seng Index. which is we're doing 30% Hang Seng Index, and we're doing 40% S&P. Okay. Now, Hang Seng Index actually was down a little bit over that time period. So it started off at a level of about 31,000 here, and then went down to about 28,000 by the end of the 2-year period. Now, the Nikkei started off at about 22,500 and ended up around 23,200. So it went up just a little bit. And then the DAX index, which is based in Frankfurt, started off at a level of about 12,500 and ended up at a level of about 13,800. Okay. Now the Nikkei, we're giving a 20% allocation, and the DAX, we're giving a 10% allocation. Okay. Now, that's the performance of each of the indexes in their own currency. And then what I've shown below there is the performance of the Nikkei and the DAX in dollars. And you can see that there's not a whole lot of difference there between the performance of the Nikkei index. It really, you see a very slight upward movement in the index over that period. The shape is more or less the same. Now, with the DAX index, actually, you see something where in dollar terms, the DAX index started off at about 15,500 and then ended up around 14,000 and say about 700. So actually the DAX went down a little bit if you looked at it in dollar terms. Now, what's going on there? Why is it going up, in euro terms and then down in dollar terms? Obviously, it's because the euro got weaker or the dollar got stronger. But basically, that's the same thing. So anyway, now you have a good look at the data, and you have an idea of overall what the individual indexes have been doing. And then in the next part of our project, we're going to combine them all into a portfolio and then look at some statistical measures of how much risk is there, looking at things like volatility and kurtosis and so on. So for now, you've got an overview of what is going on in your portfolio during the historical time period. And you have a sense that really there hasn't been that much risk there, but now we're going to actually measure that risk and measure it in our portfolio with our allocations. Okay, now we're going to look at the second tab in our workbook, where we've done our portfolio allocations, and we're going to look at the performance of the portfolio on each of the 500 trading days in our data set. So let me share my screen with you. Okay. So here is the second tab. And as you can see in the upper left-hand corner, you have some statistical measures. You show the portfolio allocation. You show the index levels in dollars on the first day of our data set. And we also have some statistical measures there showing the minimum and maximum and mean and standard deviation and skew and kurtosis for our loss function. So now we're going to be looking at portfolio performance in terms of loss, because as risk managers, loss is what you're focused on. When you calculate, our most common measure of risk, value at risk is a loss number. It's the maximum loss that you expect with a certain level of confidence. So just focusing first on the upper left-hand corner here. So we have our allocations, and as I said before, we allocated 40% or $4,000 to the S&P 500, which is the GSPC ticker symbol. We allocated 30% to the Hang Seng, 10% to the DAX index in Frankfurt, and then 20% to the Nikkei index. Now, what we see next to that is the price of each of those indexes at the beginning of our data set in dollars. And so we see that the DAX index, the S&P 500 index is at 27.79. The Hang Seng index in dollars is at $39.44. The DAX index at 15,279, and then the Nikkei at 205. Now, the size of the index doesn't matter because we're going to allocate, our allocations based on a dollar amount of that index. So even though the Nikkei is a small index in dollar terms, it's still going to be 20% of our portfolio. Okay. Now, if we look to the middle of our tab, our portfolio loss, what we see are the same data that we saw before in our data set, except now we've converted it from indexes to portfolio values. So when we look at our first GSPC number or S&P 500 number, 3,949.17, that is the value of $4,000 invested on day 0 on day 1. So in fact, the S&P 500 index, if you go back and look at the data set, went down from day 0 to day 1. So we can go back and look at that right now. And what we see, just going back to our data set, here we are. Okay, and that's what we see. We see that the S&P 500 was 27.79 on day 0, and then it was 27.44. Okay, so the index has gone down, so the value of the $4,000 that we've invested in that index also is going to go down in our portfolio. All right, going back to the portfolio loss tab. So that's what we see. We see a loss based on that decline in the index, but now we're looking at dollars in our portfolio. And we repeat that same calculation. So you can see the calculation here. So basically, we are pulling our data from the data tab, and then just saying we take this B5 here, oops, the $5 there is just the $4,000 that we're allocating times the ratio of the price on day 1 to the price on day 0. Okay, so that gives us our value for the S&P 500. So that's $4,000 times that ratio. And then the Hang Seng would be $3,000 times that ratio. So also the Hang Seng index on that first, from day 0 to day 1, lost a little bit. The DAX index also lost a little bit because remember the allocation there was $1,000. And the Hang Seng was $3,000. And the S&P was $4,000. Okay. And the Nikkei was $2,000 here. Now, the Nikkei was the exception. So the Nikkei actually went up in value on that day. And this is what you're going to see a little bit. These indexes are not perfectly correlated. So generally they may move together, but sometimes you'll see one index going up and the others going down. So you have a bit of a global diversification benefit. So once we combine all of those components of our portfolio, we come up with an overall profit of negative 81.3, which is our loss of 81.13 also. So our loss function is just showing the loss as a positive number, or as a negative profit. Okay. And this is repeated all the way down for all 500 of our data points in our portfolio, as you can see here. And so for each day, what we're going to have is a return on that day. So what was our loss, positive or negative? Essentially, what is our gain or loss on each day? And this is what we're going to use to construct our distribution so that we can determine what kind of a distribution we have. What is the shape of that density curve? And the way we do that is over here, a little bit further to the right in our, on this worksheet. And what we see are three sets here, which are used to construct three separate histograms. And so our first histogram is our loss function. So this is our loss function. And what I've done here is you have to, in order to construct a histogram, you have to break your loss down into intervals where the loss is relative to 0. So minus 50 would be actually a gain of 50 in your portfolio. And then plus 50 would be a loss of $50 in your portfolio. And for all 500 observations, we're going to actually count up how many times the loss fell within that range. And so the actual limits of that range are, for 0, it would be minus $25 to plus $25. For minus $50, it would be minus 25 to minus 75, and so on. But you can look at these on the spreadsheet. And so we count up how many times in our data set the losses or gains occurred in those buckets or bins. And then we calculate the relative frequency. And the relative frequency is where we get our density function. So this is where we're going to get our density function. And then the cumulative frequency, that's the same as our cumulative probability distribution. So we want to make sure that this totals up to 100%, which means that all of our data points have been counted. Now, if we take the loss function and make a histogram out of it, what we get is, over here on the left, this loss function. So this is what we have. So this is our distribution. It looks fairly symmetric, fairly normal, and so on. Now, the other distributions that we have shown here are a normal distribution and then also a t-distribution. Now, we're going to be comparing that normal distribution calculated using the normal density function and the t-distribution calculated using the kurtosis of the data. And we're going to look at histograms of the normal versus our actual data and of the t-distribution versus our actual data. That's what we see here on the left once again. So we have our loss function first, which is nice and symmetrical and looks like pretty normal. And now we're going to actually compare that to a normal, we're going to compare that to a normal distribution. So just below that, our loss function is in blue and our normal distribution is in red. So what we see with our distribution is that our function shows a few more values right in the middle at 0. So it's a little more in the middle, and then a few less values than normal on the gain side. And this is true here on the losses also. So what we're seeing is that we expect fewer gains and losses within the minus 100 to 100 range than we would with the normal. So it's actually somewhat less risky there. But then as we get to the bigger gains and losses, we see we have something here, a loss around 250. And that's not expected, in a normal distribution. So that's an unusually high. And once again, that is a loss of 250. And now on the gain side, we actually see that the normal distribution has more big gains than we do in our data. Okay, so what we're looking at is something that's kind of pretty normal, but maybe has less kurtosis than a normal distribution. So we'll look at that in just a second. And then the last thing we look at is comparing our data to a t-distribution. And here, even more so, we tend to see, once again, that more values around 0 than a t-distribution, but a lot fewer values in the, the minus 50 and so on. So pretty much this distribution looks to be, somewhat less risky than the t-distribution. So there, especially on the losses. So it seems to be a fairly low risk distribution. Okay, now let's go up to the upper right-hand corner where we showed our allocations to our portfolio. And now let's look at the statistical measures that we have for that data. So for the 500 data points, which we're going to call 500 scenarios, so each day is a scenario effectively, we can see for losses that our minimum loss, so this is actually a gain here, is a gain of about $179. So that's the biggest gain or the minimum loss. Now, the maximum loss, which is what we're more interested in as risk managers, was 236 here. So that means on the worst day in the 500 days or 2 years of this portfolio took a loss of $236, or actually $237. Now, that's about, 2.36%. That is not a very big loss if you consider you're looking at 2 years of data. I mean, that's actually very small for this period. And as I said, this was an unusually calm period for the market, where you didn't see any big sell-offs or any big movements in the market particularly. And we see that when we look at the kurtosis for the data set, and that's 0.8262. Now remember that a normal kurtosis is equal to 3. So this has less kurtosis than normal. So really you're looking at something that is below normal distribution risk. Okay. So, okay. And that's the statistical measures that we have. Next, we're going to look at the portfolio value at risk and how that's calculated. And that is in the third tab. Okay. And Make this a little bit bigger again. All right, so we have the same information that we had before about our allocations and also our statistical measures. And then below that, though, what I've done is created a table that calculates the value at risk for different confidence levels. And so what you would expect if you have a higher confidence level, which means your alpha is smaller. So for, say, the 99.99 confidence here, that means your alpha equal to 0.01. Okay. So for that, the value at risk that we calculate from our data is actually equal to 151.7. Now, in calculating this, I use a function called percentile.exe, which is an Excel function that basically looks at all 500 data points and then takes the percentile and says, what would the cutoff be in those 500 data points if I'm taking 1% of the worst losses? And then I want to see what would be my loss, 99% of the time. So no greater than that. So that's what percentile.exe does. And as you can see, it looks at the entire data set. So that's the all of the returns that we have, all 500 returns, and then looks at the confidence level, which is that A24 there is the 0.99. And so what you would expect is that the higher the confidence level, the bigger your value at risk, because that means your tail, or what's left over once you take the confidence interval, has bigger losses, or you have an area that has more of the big losses. So if we go to a 98% confidence level, so alpha equal to 0.02, so that means we're going to look at what is our loss 98% of the time. Then we're down to 134.20. So there. And what I've also shown is that these estimates of the value at risk, they're not precise. So once again, these are statistical estimates and they have a certain error. And so what I've also shown is the standard error and how you calculate the standard error for that estimate of value at risk. And so I've calculated that for each of the confidence levels. And based on that standard error, you can actually say that you have a high and a low range. And this, say, 151.71 is right in the middle of that high and low range. So our low, based on actually a 95% confidence level in our estimate of value at risk, is 135.45, and our high was 167.97. And this is our average. Okay. Now, so you can see that for all of the values there. And this information is also graphed for you over here. Let me make this a little bit smaller. So what we see on the right-hand side of the tab is, once again, our loss function here. So we don't need to look at that again. And then what I've done is graph the value at risk for our portfolio for different levels of confidence. So this is 90%, and then all the way up to 100% here. And you can see that, it goes up, and the dotted lines are the high and the low interval for that confidence level. And now what we're going to do is we're going to compare that to the expected shortfall. And so you'll remember from the course, expected shortfall is the measure of risk that's used by or recommended by the Basel Committee, and is a more robust measure of risk. And that measures the average loss once you're in that value at risk tail. And so expected shortfall is going to be bigger than your value at risk. And the second graph compares value at risk and expected shortfall. And as you can see, expected shortfall is higher than value at risk. And the difference between the two of them tends to increase. And that's the third graph here. The CN is the space between the expected shortfall and the value at risk increases as you go to higher levels of confidence. Okay, so, good bit of information here. And as I said, for the time period that we're looking at initially, there's not a lot of risk here, but what you're looking at are some good ways of measuring risk once you finally look at it. And you're going to be looking at it in the second part of this project when we look at that data set for the 6 months after February of 2020. Now, just as the final thing for this worksheet, we want to compare. Before, we compared the normal density function with our density function for our data. You can also do that, compare the normal value at risk to the value at risk that we get from our data. And so that's what we're going to show here. So once again, here we have normal value at risk, and we're going to compare that to the value at risk for our data. Okay, and we have the same kind of graphs over here that we had before, over here on the right. And what we see is, in fact, that for lower levels of confidence, the value at risk is approximately equal to the normal value at risk. Now, as you go to higher levels of confidence, where alpha is smaller, then you see a bit of a difference between the value at risk and the normal value at risk, or the value at risk you get if you had a normal distribution. And same thing with the expected shortfall, fairly close for lower confidence levels, and a bigger difference here for higher confidence levels. Okay, so that's just another way of measuring things. And we're going to come back to each of these measures in the second part of the project when we look at that new data, the 6 months that came after February 2020. Okay. Now we're going to look at our second data set, which is exactly the same as the first data set, except we're adding 6 months of new data. So the post-February of 2020 period, and then we're going to remove the first 6 months of data. So we'll still be using 500 data points or 500 trading days for our portfolio. What we'll be including in our 2-year window of data is 6 months during which the COVID epidemic unfolded. So going from February 2020 to August of 2020. And we're going to want to see how that affects the distribution of returns in our data and how that affects our measurement of risk using value at risk and expected shortfall. So now let's look at the data. Okay, so in our second workbook, you can see the data is laid out exactly the same, except now the start date is in August 27th of 2018. We have the same indexes that we're using to construct our portfolio, the same allocations, and once again, we're going to start off with $10,000 portfolio and look at changes in the value. And so everything here in the data section is the same, but what we want to first do is look at the new data, sort of the addition of that 6 months, and see what that's kind of done to our risk. So we look over here. At our graphs of the performance of the indexes that compose our portfolio. And we can see that actually a lot more is going on, especially once we look at the later part of the data. So in the S&P 500, we see a pretty massive sell-off and then a recovery. So the sell-off and then the recovery. And in the Hang Seng Index, we also see a very big sell-off with a smaller recovery. Nikkei, big sell-off, same big recovery. And in the DAX, also a big sell-off and a recovery. So what we're seeing is some pretty extreme volatility once we include these additional 6 months of data or these new 6 months of data. And we also look at what this looks like when you convert it into dollars for the Nikkei and for the DAX, and essentially it looks about the same there. There wasn't a whole lot of movement in the exchange rates between the yen and the dollar and between the euro and the dollar. And what I'd also say is generally these equity indexes and equities move around a lot more than exchange rates. Exchange rates are generally very stable, especially for reserve currencies like the euro or the yen or the dollar. Okay, so what we see is that we probably are going to see a bit more risk in this data. And then when we go to look at our risk measures, that will be reflected in those risk measures. So let's first look at portfolio loss. Okay, now, if we look at our loss data, just that initial graph, what we see is that the data is much more spread out. The losses, or there are more losses that are bigger, much bigger than before, and also gains that are much bigger than before. So we see that we have a gain here of 700, that's a minus 700 loss. And we have several losses, one around 800, 700, 600, 500, a lot around 400 and 300. And remember in our earlier distribution of the 2 years, not including the COVID period, none of this was present. We really had our largest loss was $236. So all of these are new. And also these gains, they're also new. We didn't have any gains that were so big as $700 or $400 or $300 in a day. And so you can also see this when you look at the statistical measures for the portfolio. And what you see is that the minimum loss right here at minus 762, so that was the largest gain in one day, $763. So that's almost an 8% gain in one day. And then our maximum loss in one day was very similar at $738. So we're looking at, more or less 7-8% gains and losses in a single day. Now, the mean over this time period, because the market overall went down, is slightly negative. What it means is that our mean loss was minus $2, so we gained $2 on each day. So overall, the market was going up during this period. And you can see that if we go back to look at the graphs on the first data set, you can see generally the markets were going up, especially the S&P 500 is much higher than where it started. And the other indexes are pretty close to where they started. But the S&P 500, which is our largest weighted index, is significantly higher than where we started. And so that's accounting for most of that $2 a day gain in our portfolio on average. Okay, now looking at other measures of statistical measures. So our kurtosis, now that's a really big number there. Now, kurtosis of 16 means just really you have extreme kurtosis. So that means a lot of big gains and big losses, and you would expect relatively less than a normal distribution of returns that are around zero. So we'll see if we see that when we compare our loss distribution from our data to a normal distribution. So we're going to do that right now. And that's what I've done here. The same as in the first data set, I've used the, right here, the functions to create histograms for our data set, and then for creating a histogram for the normal and also for the t distribution over here. So we have our normal t, and then this is our data right here. And these histograms I'm going to use to compare our data to a normal and a t distribution. Okay, so we go back over here to our graphs, and we'll make these a little bit bigger. So the first one we're going to look at is the graph of our data, which is in blue, the loss data, compared to the normal distribution. Okay. And what we see is that the normal distribution does not include all of these gains here that we saw before, maybe a little bit there at a gain of 300, and definitely doesn't include these losses of 500, 600, 700, and 800. The other thing that we see is that it's a little bit unusual. The normal distribution has a much higher likelihood of a gain of 200 than our distribution, and a loss of 100 than our distribution. So that's the leptokurtosis. Now that's a little bit offset by, a higher probability in our distribution of not much happening, so the zeros, and these two are more or less the same, slightly higher in our distribution. But so we have a sort of a low probability of these gains that are kind of in the middle, but big high probability of large gains and losses, which means we have a lot of risks there, because these gains out here, or excuse me, these losses out here, those are our tail losses. So these are our tail losses, and these are what determine our value at risk. Now, I'm going to show you a couple of different ways of calculating value at risk this time. Now, we'll go to our portfolio value at risk in just a minute. So first, we'll look at the normal distribution versus our data. Now we're going to look below that at a t distribution, which includes that kurtosis. And so that's the T distribution, including the kurtosis. And you can see that it's a lot better matched to the data than our normal distribution. So you can see that these two are pretty close. And these are very close here. So that's a good match. This is a good match. And so pretty much you have a much better match if you use a T distribution to describe your data in this case. Now, what I'm saying is that, what model would you use to model risk going forward after this period? So that's what we're trying to do here. We're saying, all right, we've had this 6 months additional extreme volatility. Now we have to decide what is the best distribution to use to model that and to model the risk in that volatility. Okay. Now, going to the third tab here, and that's going to look at our value at risk. Now, let me break this a bit bigger. Now, one thing that I wanted to show you that I didn't show you in the first part of the project when we looked at the first data set is that there are a couple of ways that you can figure out your value at risk. Now, what I've shown here is a way of calculating value at risk using the percentile.exe function. So that's one way of doing it. But if you don't want to use percentile.exe, then another way of calculating value at risk is to simply rank order all of your returns, as is done in the columns here in the middle now. So we have 500 days of data. So we have 500 daily returns. And what I've done is I've ranked those returns in terms of the largest loss down to the biggest gain. So one thing that this does, because it shows us obviously what was our biggest loss here, which was $738 loss. It also tells us when that loss happened. So that loss happened on the 389th day. So that means that it happened in our data set, which was 500 data points, more towards the last quarter or in that last 6 months of the data. And you see that as a pattern for all the losses pretty much that are big here. They all pretty much happened in the final 6 months. So that new data is where all these losses came from. They're all high numbers, so they all happened in those 6 months. Now, the other thing that you can do here is we calculated earlier a 99% value at risk. Now, I calculated that 99% value at risk here using percentile.exe. Okay, so that's one way of doing it. Now, another way of calculating a 99% value at risk is to say, okay, I have 500 observations and my value at risk will be for 99% confidence level, I'll need to look at the 1% worst losses and then see what is the, best loss of those worst losses, if you can say that. So if I want to do that and I have 500 data points, 1% of 500 is just 5. And so if I look over at my rank scenarios, basically if I go to scenario number 5 here, and that would be right here, drawing a line there. So my 5th worst scenario was scenario 401, and that was a loss of $361 or $362, okay? So that's just using rank scenarios to calculate a value at risk, with a 99% confidence level. Now, comparing that 362 or so is basically exactly the same thing. So these two are almost the same thing. They're not exactly the same thing because percentile.exe is performing an interpolation between the values a little bit. And so it'll be slightly different. But like I said, you can eyeball what a 1% value at risk would be. And you can also do that for a 2% value, a 98% value at risk. So that would be 0.98 here, and that's 236.92. And over here, that would be observation 10 and also 236.92. So I just wanted to show you that, the value at risk is really just coming from rank ordering those losses and then deciding what is that value at risk cutoff, that loss level that you don't think you'll exceed, 99% of the time or 98% of the time. Okay, so other things that we notice here is that, let's see, looking at the graphs of the value at risk, so which are shown just over to the right. Let me just put that there. Okay, so here, we see that our value at risk is much higher than before. And actually, it goes right up off the graph. And if we look at our value at risk versus our expected shortfall, we see that, as we expect, the expected shortfall is higher than the value at risk. But as you get to that last data point, essentially they become the same thing just because, you only have one data point and, that's your average value, and your value at risk is closer to your expected shortfall in this case. Okay, but you can see in both cases that they go up pretty dramatically. And you can see that in the table here that I've shown. So our value at risk now for 99% is 361. And before, when we looked at the earlier data set, let's see, it was 151.71. So that's looking at the other workbook. So basically, your value at risk has more than doubled, just by including this new data. Now, the question you have to ask yourself as a risk manager, is it likely that we're going to continue to have this volatility going forward? So is 361 a reasonable estimate for the value at risk for the next 6 months? Now, it's obviously, it includes, 2 years of data, but really it's driven a lot by those last 6 months because that's where everything happened. And so really, you might say, okay, do I think that this volatility will continue or not? And honestly, if you were thinking back in August of 2020, you may not know that. You may, that was before you had a vaccine. That was before lots of things had happened. And so that probably was a reasonable estimate of volatility, at that time. Okay. Now, there are a couple other things I wanted to show you. Now, we also have a tab which shows the normal value at risk, so we can compare our normal value at risk with our value at risk for our data. And we do that here. And what we see, just looking at our graphs here, is that our value at risk for our data is actually lower than normal for confidence levels up to about 97%, and then it goes a lot higher for confidence levels that are greater than 97%. Greater than 97%. And we also see that with the expected shortfall, the normal expected shortfall and the expected shortfall for our data that were consistently higher than that. So in all cases, no matter what the level of confidence, our data set shows a higher expected shortfall, which makes sense, because really, like I showed you, if you look at 90%, so that would be the top 50 losses, because you're taking 10% of the data, and probably almost all of those occurred in those last 6 months. And so it's going to be higher than normal, because that was just a very, very volatile period. Okay. Now, what we want to say is, okay, so if the normal density function or distribution is not a good way to model this, and we want to model it with something that's going to approximate it better, then we're going to look at a t distribution where we incorporate that really high kurtosis. And that's the next tab that we have here. Okay. All right. So here we've done a model where we're modeling a t distribution, and we're looking at t value at risk versus our portfolio value at risk. Okay, and so what we see is our t value at risk is over here under t bar, and our dollar value at risk, and this is from our data right there. And so if we compare those, for 99%, we see, once again, 362 roughly value at risk for our data. And then for our t distribution, we get 293. So closer, not quite there, but closer to our data. And we can see that when we look at our graphs of the value at risk versus the t value at risk. Let me make these bigger. Okay. What we can see is the same pattern that we saw before, where our data actually showed less value at risk for the data up to about, in this case, 98%, but above 98%. So above 98%, we see our data showing much higher value at risk. And we also see that our data has a higher expected shortfall, but we also see that the distance between the expected shortfalls is smaller once we use our t value at risk and t expected shortfall. We tend to get a closer match. So if we were going to model risk going forward, then probably in this case, the t distribution using the kurtosis would be a better choice than just using a normal distribution. Okay. Now, the last thing I want to show you, and this is something that is just another statistical method for looking at data, is called a weighted value at risk. Okay. Now, weighted value at risk is where you're saying, okay, I have 2 years of data, but now a lot of that data is really old. And so you're saying, is the data that I had for, 2 years ago of the same value as the data I have for the last 6 months or the last month or so? Now, we always talk about saying, oh, we need to use 2 years of data. And so, that way we get kind of a long-term view, a complete, picture of our risk. But the reality is a lot of times, the world that we had 2 years ago may not be anything like the world we have right now. And maybe it's not a good practice as a risk manager to use data that's that old in order, 2 years old, to model today's risk. Now, one way of including all of the data, but putting more weight on more recent data and less weight on, older data, is using exponentially weighted data. And so essentially what it does, it says that we're going to weight the most recent data most heavily. And then as we go further and further back in time, we're going to weight that old data less. And we're going to use an exponential formula. So essentially the weight will decrease exponentially as we go to earlier and earlier dates. And the only constraint that we have is that we want all those weights that we're going to apply to each observation to sum up to 1. So we want the weight to be 100%. And now if you think about it, if you were looking at our original data here, where the weights, or the original data with the weights where we were just having all the weights equally, what would the weight be equal to for an observation? And so really, we have 500 observations. So our weight would be equal to 1 divided by 500. Which is equal to 0.005. Two, excuse me, 0.002. So basically, if you multiply 0.002 times 500, you get 1. Okay. And so that means on average, the weighting will be 0.002, but the old scenarios are going to get a much smaller weight. And you can see that because the weighting on the old scenarios is more like 0.0002, so 0.00022. And essentially that's like 1/10 the weight. So it's 10%. And the weighting we're using in this example is 0.93, which means that as you step back in time each day, you reduce the weight, or you multiply the weighting by 0.993 to reduce it as you step back in time. Now, if we look at the data, and we get more towards the middle of the data here, say around 250. Now, it's not going to be exactly 0.002 because it is exponentially weighted. So actually at 250, the middle of the data, we're only at 0.0125. So we're not, at 0.002. But if we look at the last data, so that would be all those, like what happened yesterday, if we were, right there in August of 2020, we're going to weight that 0.0072. So it's going to get a much heavier weighting, like 3 times as high or more than that as the average weight that we had before. And so this is just a way of saying, okay, I'm going to keep all the data, but I'm going to make the more recent data more important and the old data less important. And there's just a statistical method to do that. Okay. And just going back here. Okay, so what I show on the left is just our distribution again. This is a graph of the weighting. And so you can see it goes from 0.007 here, all the way down to 0.00022. Okay. And then if we look at okay, so that's just another statistical method that you might consider using as a variation. Okay, now let's step back for a minute. So this is a project, and you're going to be answering a few questions about what we've been discussing here on different methods. And what I'd like for you to do is I'd like for you to take your own portfolio, if you have a portfolio of stocks, or for you to create your own portfolio if you like to, and try to use some of these methods to look at the risk in that portfolio. And I think what you'll find is that, depending on your investment taste, that the risk may be much greater or much less than you think. And I'd like you to also, think about combining, different stocks in your portfolio. I mean, here we've combined different indexes. So an index is already pretty diversified. It's a whole bunch of stocks. But, you could try, 4 different stocks. You could try 4 different digital currencies. You could try, pretty much 4 different of anything, or you can try even more assets than that, and, try out some of these methods yourself. And then, since this will be, on a user forum, try sharing that with other users on the forum and, see what other users say about your analysis. Okay, so as I said, we'll have a quiz after this that'll talk about, some of the things that we've discussed. And then I encourage you to also use some of these methods on your own portfolio. So thank you. Thank you for taking Course 3, Market Risk Management Frameworks and Strategies. I hope you've enjoyed the course. So in Course 3, we went through talking about different financial instruments and the risk factors that measure the sensitivity of those financial instruments to changes in interest rates or changes in prices of equities and so on. We then looked at statistical models and probabilistic models that help us better understand those relationships and model those relationships so that we can measure and model the risk in financial instruments and portfolios of financial instruments, so portfolios of bonds or portfolios of stocks. Lastly, we looked at measures that are used by risk managers of risk. So these are measures of risk that's going to be in the future. So it's not risk that we've seen in the past, although many of these measures are modeled using risk, from the past, using data from the past, 6 months or 2 years. These are measures that are supposed to tell us what kind of risk can we expect over the next day, over the next 10 days, over some time horizon in the future. Because what we saw in this course are that even though we can see the prices and what financial instruments or stocks or bonds, we've seen what they've done in the past, we know exactly what they've done, we really don't know what they're going to do in the future. We can only try to predict that because from our perspective today, the price of a bond or the price of a stock or the price of a derivative is a random variable. So this course was all about, modeling random variables and coming up with measures of the risk of a probability distribution or a distribution of a random variable or a density function or a cumulative distribution function, coming up with measures that would tell us about how much risk are we exposed to. And the first one we looked at was value at risk. And now value at risk tells you how much risk or how much of a loss you can expect to take with a certain level of confidence over a certain time horizon. It also tells you that you will not exceed that loss a certain percent of the time over a certain time horizon. Now, there's no guarantee with value at risk. You may have a value at risk that says, oh, your portfolio value at risk is, say, $100,000 loss. And you may experience a loss much bigger than that because, once again, we're dealing with random variables here. And the value at risk doesn't measure the worst loss. It only measures the worst expected loss a certain percentage of the time. It doesn't measure the loss the other percent of the time, the rest of the time. So, but it is very useful. And then we also talked about using expected shortfall, where you actually look at what that loss is the rest of the time when it's a really big loss, and you take an average of that loss. And so that's what's used more and more by risk managers. So we looked at that too. Now, I hope this has given you a few tools and also the ability to look through the project where we're looking at a portfolio composed of stocks or stock indexes from different parts of the world. So an internationally diversified stock portfolio where each of the indexes or each of the stocks is in a different currency. So you have currency diversification, global diversification, and we've looked at that. Now, coming up in the specialization, so just kind of looking at the specialization in perspective, first we had our introduction to risk management. That was course 1. Second, course 2, we had credit risk management. So that talked all about, credit risk and really focused on credit risk in bonds and other types of loans, or pretty much anywhere where you're lending money, focused on credit risk. Now we returned to credit risk in course 3, this course, when we talked about bonds. But really, we didn't focus so much on credit risk. We focused more just on changes in interest rates, not so much changes in credit quality. And now coming up in course 4, which will be the last course in this specialization, is operational risk management, frameworks and strategies. Now, operational risk is something completely different than what we've been talking about so far. Operational risk is very difficult to measure using the tools that we've learned so far, because operational risk is something that is embedded into different processes, business processes, decision processes, reporting, could be in systems, could be in how data is stored, how data is protected. Really, operational risk is something that is throughout an organization, whereas, market risk, credit risk, these are very definitely associated with financial assets, and they're actually relatively easy to model compared to operational risk. And so we'll see with operational risk that the tools we use to manage operational risk are, in some cases, quantitative, but oftentimes managing operational risk is more of a qualitative process. It's a process of creating organizational, informational structures that allow you to identify operational risk and then decide how you're going to manage them, if you're going to manage them at all, or whether it's not cost effective to manage them, and so on. So I hope you'll have enjoyed this course, and I hope you'll enjoy course 4 also. Thank you.